What's up, team? Sean from Vesta Live here, and I've got a really interesting one for you today on a Sunday where I wanted to kind of get back to basics on a couple of the key things that I look at when I'm looking at technology or SaaS businesses that can sometimes get a little bit overcomplicated, and we miss the boat on why it's so important to focus in on a couple of really key metrics that can drive a lot of results, both for the company, but as well as the associated stock price growth, market capitalization, etc. Before we jump in, as always, this is not financial advice. This is education, right? I don't know your financial situation. I don't know your cash flow. I don't know your earnings. So always take this as part of the strategy of what you're learning about and how you're executing on this. And a little bit extra on this, I think people wonder why this gets talked about a lot on YouTube and why we throw financial disclosures out there. Here's the reason. A true financial analysis of your personal situation is not based just on your stocks, your investments. It's really based on your entire profile, how you earn, how you spend, your long-term needs, your short-term needs. This is why it's important to understand that any strategy should be just that, part of a strategy, right? So make sure you're doing that with everything. These are really basics, and these are things you need to know if you're an investor in today's modern market, especially in growth stocks. So without further ado, let's jump in. My absolute two favorite things I like to talk about is NRR and CAC. What the heck are those, right? NRR is net revenue retention, and I'll go into that in a little bit, and CAC is customer acquisition costs. These are extremely important for so many more reasons than just another box we check on an earnings call. And I think that truly we're missing the boat of understanding what they're telling us about the companies we're investing in. But before I do that, I want to give you a really basic example of how I think about this. So say I go to my mailbox and I've got a postcard from an oil change shop near my house. And it says, hey, come on in, $5 off an oil change, right? They're marketing to me. I know you probably know all this, but I want to tell you the story anyways. They're marketing to me. They paid a certain amount of money to get that put into the mail, have it sent to my house, have it designed, etc. And they're building that coupon cost as part of that campaign, right? So I see it, I think, hey, I need an oil change. I'm going to go and bring my vehicle in and get it done this weekend. So I go in, hand them my card, and say, hey, I'm a new customer, but I got this coupon. I want to save $5 on my oil change, right? There is a cost associated with how they got me to actually get through that door, okay? That's the initial cost of acquisition of me as a customer. Really basic stuff here. Once I'm inside, they take my car, I sit down in the waiting room, probably look at some magazines or play around on my phone, which is almost definitely what I'm going to be doing, looking at the YouTube videos. And they come back out and they say, hey, Sean, listen, we're about to kick off your oil change, and we noticed as part of our general check, you also are a little bit low on coolant. Or perhaps two of your tires are bald, or maybe your wipers need to be replaced, right? So what they're trying to do is they're trying to increase the spend that I have now that I'm organically in their shop after that initial acquisition. So the effort here is to go from that oil change at $5 off into a new set of wiper blades, or maybe tires, or maybe a coolant exchange, or whatever else they're going to do. Now, maybe I do this, maybe I don't. Maybe it's a good thing, maybe it's a bad thing. Maybe I'm the right type of customer for this business, maybe I'm not. They don't know yet, but this next decision helps to drive the process. Now, say they say to me, well, we already have it in the air. What would normally take an hour to do a coolant exchange, we can do in 15 minutes because it's already up there. We can drain it right away. I say, sure. So I came in for a $30 oil change. I end up leaving with a $100 bill for oil and coolant. I feel good. I got it done when I was already there. They feel good. They increased their revenue on that customer. This is a really basic way to think about the idea of how do we get more revenue from a customer, whether we think about it in terms of an upsell like an oil change shop, or we think about it as a SaaS company as additional features or expanded usage of the product that I initially signed on for. It's really, really this basic when you think about it in the world of tech. I think lots of folks like to tell you how complex SaaS is and how the world of software and sales is extremely hard to understand. I've got news for you. It isn't. It's extremely, extremely simple. So I want to take you down this journey of what customer acquisition costs, net revenue retention are, what they mean and how to think about them, why I happen to love them, and what I think the bigger real hidden value here is for long-term customer growth. So first and foremost, so what exactly is customer acquisition costs? And oftentimes we'll see this abbreviated as CAC, or sometimes we call it CAC. When I talk to folks all the time, I just refer to as NRR and CAC. So essentially, customer acquisition cost is the cost that a business has to pay to acquire a new customer. It's that simple, right? It's a metric. It's used across many industries, but it's particularly important for SaaS because with that SaaS model, it's very easy for a customer to come on board, decide they don't like something, and leave right away. So keep that in mind here, because that's going to be important for NRR. So the entire business model with a SaaS company is really based on this idea that a customer has a total lifetime value. The total amount of money we can expect for a customer to pay us, whether it's another business in a B2B example, or a consumer in a B2B2C model. Now, this is a big deal because we have to really calculate this ahead of time to start thinking about our metrics, how we're going to hit our earnings, how we're going to grow efficiently and with a high degree of efficacy. So what's more is I need to start to think about this from the perspective of how do I acquire new customers, right? While also understanding the amount of time and cost it's going to take to get them and what my long-term value from that customer will be again, right? So how long will they be in my SaaS business? How many months can I expect them to pay? What's the average customer's expected time look like? And what kind of margins do I have on that? So you might be saying, okay, this makes sense. Of course, there's marketing costs associated. I knew this already. It's pretty simple. And you're absolutely right. It isn't meant to be hard, but it's one of those things that oftentimes is really missed because it doesn't get the exciting, the sexy talk on an earnings call, the EPSs and all these top and bottom lines. But this is the driving factor, right? So one of the reasons why this is such a big deal with SaaS and software companies is because of how easy it is to get rid of it, right? If I'm in manufacturing and I sell you, a 45-ton crane, you may not love it after you buy it, but the odds are you're not getting rid of that 45-ton crane for probably 20 or 30 years, unless you can sell it at a loss, which you're probably not going to do, right? So SaaS companies have to devote a ton of their time, an absolute inordinate amount of their time, to bringing on new customers to sign up and test out their new products to try to get them to grow and be successful. Now, additionally, in the SaaS space, the reason CAC is so important is because it's not just the efforts of the marketing team and the sales team, but then when they become a customer, right, they have to then be serviced to make sure they're using the product. This means customer success. This means customer service. This means onboarding support for a lot of companies. So they have to recover all of those costs associated with profitability, which could take a long period of time depending on the amount they spend up front. So in a nutshell, that's customer acquisition costs, right? And really simple, if you think about the formula for this, and again, I feel like if you can't explain this in really simple ways, and I have to show you 45 different slides and charts, I'm not doing a good job. So I want to make this really simple. Customer acquisition costs are calculated in a really simple fashion. The total cost of sales and marketing on the top divided by the number of customers acquired. And that's our average customer acquisition cost, right? It's that simple. If I spend $1,000, excuse me, and I gained 10 customers, well, you can do the math, right? This is what we're trying to work through. So this is the idea of customer acquisition costs. There's ways to optimize and standardize. There's ways to do this better. There's ways to get into the metrics, and lots of folks in marketing will do this. I'm not going to talk about that just yet. Let's shift gears for a moment. Let's talk about net revenue retention, right? We've acquired our customers, we've onboarded them, they're part of our business, and they're paying their monthly bills. Sometimes what you hear is things like ARR, which is your annual recurring revenue. This is how much a customer spends in a year. Sometimes you hear MRR, which is your monthly recurring revenue, how much they spend in a month. A lot of SaaS companies, especially smaller or more startup, are very, very focused on MRR rather. The bigger companies that we all know the names of are very typically looking at ARR and long-term growth. But it's important to know the difference. So net revenue retention to me is the other side of this coin, right? And the one that just does not get enough attention, especially on earnings calls, especially in investor reports, especially when we're talking about the success of a company. So net revenue retention essentially is the calculation of total revenue minus churn. I'll explain this to be clear. That's your net revenue retention, right? We started the month with $100. We added 50, but we lost 25. So we ended up at 125 for the month, right? This means that some of those SaaS customers have switched off of our company. They stopped paying their bill. They're moving to someone different. And we've also acquired some new companies or customers, et cetera, to cover that. So again, really, really, really simple math here. Net revenue retention is, and this could be different metrics, could be monthly recurring revenue, or it could be annual recurring revenue at the start of the month, plus any expansions in spend, plus any upsells, minus churn, and minus contractions in contracts, right? Divided by the beginning of the time period amount, right? So I start my time period with $100 in recurring revenue. I expand some of those customers and get that number up to 110. We sell an additional 20 worth of new products of upsells, so we're at 130. but we lost 15 worth of churn, and maybe we contracted by 5, right? Then we divide that by that original starting rate of 100. It's literally that simple. But the point here isn't to understand just the calculations, because that's not what I really want to talk about. The reason why, for me, these two things are so important is it tells me everything I need to understand about why this customer is succeeding. It tells me everything about if they actually can grow their business. But let's explain why. It's nothing to do with the calculations. I actually watched about 15 other videos on this to make sure that what I was doing wasn't redundant or wasn't things that everyone in the community already knows. And as I often find, am shocked at how many people are making videos on these topics but don't seem to understand the topic. So here's why this is so important. For a company to be successful and to see a lower cost of acquisition combined with a higher net revenue retention rate, some of the things we really want to start to understand is, are they actually targeting the right types of buyers, the right types of customers? Do they know their numbers? Do they know the lifetime value of those they're targeting, right? It's not enough to be able to flip a switch and decide, hey, who are my highest propensity to buy customers? That's part of this, right? Who's likely to buy the product or the service that I'm selling, okay? The other piece of this is, how long will they likely stay on the platform? Additionally, when they're on the platform, how big are those margins on those contracts? Also, are these customers that typically are going to expand in usage? Take AWS as like a perfect example. Amazon Web Services allows you to basically host your data in their cloud. You can run processes on it. There's lots of upsell opportunities, etc. I start out with Sean Inc. and I need some of their web services, right? So I have other options though. I can go to Azure. I can go to IBM's cloud. I can go to lots of different cloud providers that are out there. I can use virtualized machines. Don't worry about the terminology. But AWS isn't my only choice. So I sign on with AWS. They get me on board and I start using it. If I enjoy it, it's a good fit for my business. Well, maybe I need to actually add some more space to store even more data or more of the work I'm working on, right? And then over time, they say, hey, Sean, I noticed you're doing a ton of work in the cloud. Wouldn't it be great if you actually analyze that data while it's already in the cloud? I say, yeah, that'd be great. Maybe let's add on some analytics on top. Cool. Then I also say, hey, you know what? I actually have some needs to pull in third-party data as well. And I already have all my stuff sitting here on your cloud. Can we open up an integration pathway to other clouds or other on-prem data sources, for example? I say, sure, right? This was a great fit for me. I'm growing my business. I need extra services. This is how you start to think about being the right persona for AWS, as an example, of course, with a growing footprint and more needs as I go. This is why AWS has exploded. They've realized the ability to get people on board with their business who are likely to grow over time, add on services, need even more growth or expansion of contract as they go. Where I get very concerned with a number of the startups we're seeing that get talked about, very exciting things, right? Cutting edge, doing cool stuff, doing all kinds of great things. You know what the truth is? When I actually look at their numbers, oftentimes it feels like they're just churning through customers with massive customer acquisition costs, all in really an effort to look like they're essentially growing by leaps and bounds, when what they're doing is they're replacing one bad fit with 2 bad fits. And then they have to replace with 4 bad fits. Now, the argument could be made that they're working through figuring out who that right persona for their business is. 100%. That's definitely true. But there's so much more, right? Are we even understanding of how and where our product fits within the market? These are the indicators that I look for when I look at customer acquisition costs and I look at net revenue retention, right? Are the same customers staying on contract, growing over time, right? Are they doing the coolant exchanges with the oil? Are they doing the wiper blades? Okay, this is the way we really think about it, right? I'm going to give you one more example at the end here because I really want to make the point that this is so simple. Maybe I want to redo my kitchen, so I have a contractor come in. And about halfway through the project, I realized, like, you know what, now that my kitchen's going to look great, I want to do 2 more bathrooms. That contractor has done such a good job. He's kept the service going. He's doing things very efficiently, and the price makes sense for me. So maybe I ask him to add on those bathrooms. Halfway through the bathrooms, maybe I want to redo something else in my house, or maybe make the outside look nicer. So he refers me to someone else he works with who's a landscaper, right? Like this is the idea of like, how are we building long-term, highly valuable customer lifetime acquisitions that grow over time without the need for extra spend? Because that's what this is all about, right? This is the whole entire thing of this is, once I have those customers on board, my spend, my marketing, my acquisition costs need to shrink down. And that's why NRR is so important, because the margins become much bigger. The effort in retaining those customers shrinks consistently, and we can start to leverage the relationships we have post-sale with them, the success groups, the service groups, the onboarding folks, etc. So hopefully this was valuable. I got a lot of questions on NRR. And what it sort of made me realize was, I think this is just a topic that's overly complex that doesn't need to be. This is napkin math, right? I started here, I ended here, right? Divided by my starting point. That's my net revenue retention. Customer acquisition costs, total marketing spend plus total sales spend divided by the number of customers I get. That's it. That is corporate financial math in a nutshell. Anyone who tells you that this stuff is complex, I guarantee you they don't really know what they're talking about, or they're literally probably trying to read it somewhere and re-explain it because they don't do it on a regular basis. It's not to say there aren't great folks out there who know this even better than I. There's tons of CPAs, which I am not, who can talk for days on these topics. But as an investor, you need to know a handful of basic metrics, basic math, be able to do this yourself and check the numbers. Let me give you one more tip at the very end here. This is where I really optimize my own portfolio and the way that I invest as well. I take things like customer acquisition cost, NRR, all kinds of different metrics you can do, and I do little tweaks. I apply little multipliers. I might put a little extra idea I have in there that maybe someone else isn't thinking about, and I try to come up with my own KPIs, my own metrics that differentiate the way that I look at a company that gives me a little bit more value. Now, everyone can do this in a different way, but this is where you start to understand why some people blow the markets out and some seem to just chase behind all the time, right? Learn the basic math, and when you do, play around with it a little bit, right? Maybe churn because you know the economy is changing or there's a new competitor coming. Maybe churn needs to be amped up a little bit in your model to really calculate for risk that the rest of the market's not thinking about yet, because frankly, they don't need to, but maybe you should be. So with that, I really hope this was valuable. Let me be genuine here, right? Like, if this would have been better with visuals or slides, let me know. I am happy to do that. I just prefer to explain this in a way where like my kids can understand, right? I want my little ones to know very basic math where I can say, hey, if you start with this and you end with this, that difference is this, right? That's how basic I want this to be for everyone, so you can feel confident when you're looking at a company, you're looking at an earnings report, or you're listening to a call on a company. You want to have confidence in this because it's very simple and it doesn't need to be complex, right? Just tease out the things that make the most sense for you, how you invest and build that profile around yourself, because you represent a persona as well. So with that, thank you so much for watching. I'll be honest with you, I was actually really excited to do this one, in case you can't tell, because I think these are the basic building blocks of really understanding things, of really getting your arms around the market. Now, all that said, if you primarily are an investor in index funds, phenomenal. I think that's great. That's what is probably best for most people, frankly. But if you're looking at growth stocks, you're looking at high energy companies, you're looking for that next big 10 bagger that's out there, it starts with the math, and the math is really easy. But the advantage for you, me, and a handful of other people is a lot of investors are really lazy and they just won't do the math. If you do the math, I feel like you're going to be so much more successful. And that's honestly what I want anyways. If you watch till the end, let me know if you do anything unique or anything that you take advantage of. And also what I would encourage is, if there's things you're interested in hearing more about, or there's topics you'd like me to really break down that you think are super complex, let me know. I like nothing more than making the complex simple. So thanks so much for watching as always. Appreciate everybody. Have a good rest of the day all. Thanks so much.